Good evening, everyone. Speaking on behalf of Tega Industries Limited, I'm Lalit Jaising from Concept PR, your moderator for this virtual brokers and analyst event. I would take this opportunity to thank you for taking out your time from your busy schedules to join us. We appreciate your presence and extend a very warm welcome to all of you. The objective of today's live session is to understand Tega Industries' interest in raising finance when initial public offering and what they do as a business organization. Under a normal circumstance, this would have been an on-ground event, but we all are increasingly getting accustomed to this as a safer and more convenient format of attending and conducting the roadshow. We hope you gather the same or a better experience from the comfort of your home and office. Before I review the functionality of the webinar, I would like to bring to light that Tega Industries is a leading manufacturer and distributor of specialized, critical to operate, and recurring consumable products for the global mineral beneficiation, mining, and bulk solids handling industry. Globally, they are the second largest producers of polymer-based mill liners and offer comprehensive solutions to marquee global clients in the mineral beneficiation, mining, and bulk handling industry through their wide product portfolio of specialized abrasion and wear-resistant rubber, polyurethane, steel, and ceramic-based lining components. Moving ahead, you will be kept on mute throughout the event and all questions will be answered via the Q&A chat box only, where you can type your question in session or at the end of the webinar. Would request all participants to please limit yourself to 3 questions if possible and use a lowercase font when typing the question. If we miss answering any of your questions, don't worry. You can email us at ipoteam@conceptpr.com and we will try to be swift in responding back to you. Going forward, it's a great pleasure to introduce our speakers today. From the company, we have Mr. Mehul Mohanka, Managing Director and Group CEO, Mr. Syed Yaver Imam, Director, Global Product Group, Mr. Manoj Kumar Agarwal, Director, Global Finance and Chief Financial Officer. The representation from the book running lead managers are Mr. Ankur Agarwal, Vice President, Investment Banking, Axis Capital Limited, and Mr. Devan Kampani, Managing Director, Head Corporate Finance Industrials, JM Financials Limited. On behalf of the company and the lead managers to the issue, let me thank all participants for being a part of this session. I now invite Mr. Devan Kampani from JM Financial to deliver the opening remark and commence this brokers and analysts meet. Mr. Kampani, over to you.
Thank you, Lalit. Very good afternoon, ladies and gentlemen. On behalf of Tega Industries Limited and the team of book running lead managers, it is my privilege to welcome you all to the analyst and broker meet for the launch of the company's IPO. Let me formally introduce you the team from the company side, which is led by Mr. Mehul Mohanka. Mehul is the promoter, managing director, and group CEO. He has been associated with Tega Industries for nearly 2 decades. And a lot of the growth that you're seeing has been thanks to his contribution into the business. And from an academic background, he has an MBA from University of Pittsburgh. We are joined by Mr. Syed Yaver Imam, who is the executive director and also heads the global product group. And we have Mr. Manoj Kumar Agarwal, CFO, qualified CA and CS. That's the team from Tega Industries. My colleague Ankur Agarwal from Axis Capital and myself, Devan Kampani from JM. As we were getting more into the details of the company and based on our interactions with investors, I think there were 5 or 6 key themes that was very well appreciated by the investor fraternity. And let me quickly walk you through that. First, the company is a leading manufacturer and distributor of specialized, critical to operate, and recurring consumable products for the global mining industry. The company services global mining companies and its focus is end customers at mineral processing sites, which are involved in gold and copper beneficiation. Second, Tega has a very diverse product of more than 55 mineral processing and material handling products. And it makes it also the second largest producer of polymer-based mill liners, which is in fact a very key product for the company. Also, Tega operates in a very oligopolistic market with very few competitors, and therefore it has very high barriers to entry. Second important theme that emerged from the discussions was Tega's products, basically they cater to the aftermarket. The company is fairly insulated to the capex cycles, and whatever products that it is offering are linked to the operating expenses of a mining site, and therefore it is insulated from the capex cycles of the industry. Third, its flagship innovation, Dyna Prime, which is a composite liner of rubber and steel, has unlocked a very new addressable market for the company. Tega operates from 6 manufacturing sites, 3 in India and 3 globally, 1 in Chile, 1 in South Africa, and 1 in Australia. With its 3 overseas manufacturing units, 32 global sales and marketing offices in over 70 countries, 85% of its revenue comes from outside India, which clearly establishes its strong presence globally. Tega has also had a very strong relationships with some of its key customers, leading to high repeat business, with about 75% of its revenue coming from repeat business, which talks in length the story and the capability of Tega with its customers. Let me move to the details of the IPO. So the price band for the IPO is 443 rupees to 453 rupees, which at the upper end of the price band gives us a size of 620 crores, which is a 20.6% of the company's capital. And the entire offering is secondary between the investor shareholders and the promoter. The anchor book will be opening and closing on November 30th, Tuesday. We are opening the issue on Wednesday, 1st December, and closing on Friday, December 3rd, with an estimated listing date on or around Monday, which is December 13th. We look forward to your support to make this IPO a grand success. I will now request Mehul to share his journey with us.
Thank you, Mr. Kampani, for the introduction to Tega Industries' initial public offering and the issue's key highlights. Global crushing, screening, and mineral processing equipment market was estimated at $20 billion in 2020. The demand for iron ore, copper, and other metals and minerals will drive growth for the mineral processing equipment industry, while electric vehicle manufacturing will be the top demand driver for copper, aluminum, and other metals. I would now request the company team to take us through the organization's journey, its struggles, victories, subsequently take the attendees through the company's investor presentation to cover its business and financial details, as well as touch upon its key strategies going forward. Over to you, Mr. Mohanka.
Thank you, Lalit. Good evening to all my fellow panelists and those joining in on this webinar. So I would just want to spend a little bit of time along with my team to quickly take you through our journey so far. And to begin with, if we can move on to the next slide, please. Yeah. So I'd like to first start with introducing my team once again. I have with me Mr. Yaver Imam, who's been with the business for over 38 odd years now. And through his entire journey with the company, he's been through various roles in the organization and has been instrumental in the growth of the business. Today, he is the Director of Global Product Management Group, as well as an Executive Director on the board of the company. I also have with me Manoj Agarwal. He's our Director of Finance and Group CFO, has been with us for over 6 years. And my name is Mehul Mohanka. I'm the Managing Director and Group CEO. I've been with the business for almost close to 2 decades now. So moving to the next slide. We'll take the next few slides and just giving you a brief overview on Tega and our business. So Tega is in the business of manufacturing critical to operate products which are in the consumables in nature, which are used in the mineral processing plants of mining industry. So for those of you not very familiar with the mining operations, there are 2 distinct ways of how we classify mining operations. One is what we call above ground operations, and the other is the underground operations. So everything to do with the mining per se, which is the excavation of rock and mining the ore body, is what we would classify as underground operations, whether it be open cast or underground mining. And Tega has no products or services which are sold in this particular segment of the mining operation. So all our products and services are installed in the above ground operation, which is mainly to do with the mineral process plant. Now, the role of the mineral process plant is to, in the most efficient and optimal fashion extract metal from the rock that is excavated from the mine. And our role is to manufacture, design, and do value engineering and customization in manufacturing spares, which go into the critical equipment which are used in the process plant. For example, be it screening machines, grinding mills, flotation cells, and other downstream equipment right up to disposal of slurry into the tailing dams. So those are the products that we manufacture in terms of which are consumable in nature going into the mineral processing plant of the mining industry. So we are not a mining company. We're an engineering company in its truest sense. And a very high percentage of our business, because it's consumable in nature, is sticky from the perspective that almost 75% of our total revenue is repeat in nature. So that gives us very high visibility on our revenues year on year. And the balance 25% comes from conversions or new business. All our products are customized. They are designed to suit a particular application or particular operation with that particular customer. So that's the very high degree of customization that we do with our products. They're all innovated, and we add value engineering into what we do to deliver the most optimal solution to our customers and solve for all their operational inefficiencies in a most proactive manner. So we don't have products that we offer which are off the shelf, which are ready to made or in stock. Everything is manufactured, built to suit for that particular customer. And every purchase order varies from one to the other in terms of design of the product or the number of SKUs that we have. So all our customers are global players. We work with the likes of BHP, Rio Tinto, large mining groups across the world, as well as mid-sized mining companies and junior mining companies as well. In our business, the barrier to entry is very high, and one of the reasons being that the cost of downtime for a customer in such critical equipment is also very high. So they tend to repose their faith only on vendors who've been able to demonstrate over a period of time that they can solve for the issues or problems that they have on the mine site in terms of the process plant, and have a legacy in terms of being able to address the customer's concerns around operational issues. Now in Tega, because we've been in the business for over 40 years now, we have a large database of applications across the world with different equipment, particularly grinding mills. We have operating data from different mills across the world, different mine sites, handling different ores. And we are able to leverage that using simulation softwares and being able to determine the most optimal solution for our customers when they approach us. Hence, it's an oligopolistic market. There tend to be not more than 3 to 4 players in general in our industry. And we have been gaining market share along the way. Moving on. This is a description of our journey so far. So if I was to break it up into 3 distinct phases, I think phase 1 was our birth, which was in collaboration with a company called Tega in Sweden. Tega was a technical collaborator with Tega in its formidable years, which then converted into a joint venture over a period of time. And the initial years were a struggle for the company in trying to introduce and be the first mover in terms of introducing the use of polymer products as a wear and abrasion resistant material in material handling in the steel plants and the ports and cement plants in the country. So typically, customers would use manganese steel as a lining substrate for wear and abrasion and impact application. And we were the first ones to pioneer the cause of bringing in the use of polymer as an alternate to manganese steel. So those were the initial periods of seeding the market. And we spent a considerable number of years in growing our business within the country. And around 98, 99, there was a significant shift for us, wherein our collaborator, Tega, was acquired by another Swedish company in Europe. And that brought an end to the collaboration agreement, which was restrictive in nature in terms of, did not allow us to sell or market our products outside of India. So with the end of the culmination of the collaboration agreement, we were then free to sell our products and services across the world. And that's when we ventured out and we spent the next decade, which was, I would say, phase 2 of our history or growth journey in establishing our presence across the world globally in different markets. In a relatively short period of time, we were able to build a strong brand for our products in different mining markets across the world. And around 2006, in that same journey, we ended up acquiring a small company in South Africa called Baruch Equipment. It's an acquisition which did very well for us. It was important for us to have made that acquisition to be a local entity in the African continent. And buoyed by the success of that acquisition, we ended up acquiring 2 additional businesses, one each in Chile and Australia in 2011. And that was around the time when we brought in growth capital from T Associates, which is a private equity partner. And then the third phase of our journey was the consolidation of the acquisitions that we had made, further penetration into different mining geographies across the world. And of course, the present day where we have a product called DynaPrime, which we brought from our product R&D stable and introduced into the market in 2019, and has clearly been a disruptor in the market in terms of substituting steel linings in the market and gaining a lot of traction globally. So moving on, this is just a quick descriptive of what a comminution circuit, or what we call a grinding circuit in a mineral process plant looks like on a mine site. So on the left, you would see is the crusher and screening operation, followed by the milling section. This is where all the grinding of the rock happens, where boulders of the size of maybe 400, 500 millimeters reduced to probably 200 microns, just hypothetically. And we provide products which go into each of those equipment. Other than the crusher, we are mainly on the grinding mill side. When you see the boxes in blue are products that we supply into each of these equipment as a solution to our customers in optimizing their plant process. So moving to the next slide. This is our product basket that we manufacture in our different manufacturing locations across the world. The mill lining product suite is called the DynaMax range. So we have the DynaPrime for large milling applications, DynaPulp, which helps in evacuation of slurry from the grinding mill, and then DynaSteel and DynaWear, which are all part of the mill lining suite. These are all dependent on the application and the size of mills and the operations of the customer that we pick each of those products depending on what the application demands. Hydrocyclone is an equipment that is used to separate different minerals in a slurry using centrifugal force and density. Screens and trommels are used in sizing of different rock particles as it comes through the mine and as through the process. Conveyor products are a whole basket of accessories that we install on the conveyor belt, which aid in reduction of spillage, from dust control to reduction of cost for the customer in terms of power consumption, and reduction of maintenance costs for the customer by use of these products. We also have a vertical called services business. This is primarily to do with installation services of our products, health monitoring of our products by using wear measurement systems such as laser scanning technology. We also assist customers with inventory planning and control. So these are all part of the services business that we also offer to our customers. So moving to the next slide, this is the present construct of our board of directors. We have Mr. Monka, the founder, chairman, and executive director on the board. I've introduced myself and Yabar. Then Mr. Hemant Nerurkar, who's ex-managing director of Tata Steel, has been on the board since 2014. Mr. Sinha and Mrs. Dubashi recently joined our board in May of 21 as independent directors. And we have Mr. Rudolph Edge, who's also an independent director on the board since 2014. So it's very pertinent to note that we as a company have always been very, very strongly focused on corporate governance. Ever since inception, we've had a large portion of our board being represented by independents. We've always had a big four audit firm right since the 70s, right? So on the day we started our business, and it was all aimed towards ensuring that corporate governance and the way we manage our business is always right up there compared to those in the listed space, even though we were not required to. Moving to the next slide. Yavar, if I could have you come in.
Yeah, the industry that we operate in, we are already insulated from the capex cycle as well as the commodity pricing because we are in the operating plant only. If you see the global mill lining market, 75% of the market comes from copper and gold. And copper and gold occur at a very low grade as far as in the nature ore is concerned. If you look at copper, today the grade is 0.53%, which means that to take out 1 ton of copper, you have to process around 200 tons of ore. Similarly, in gold, you have a grade of 9 grams per ton. And going forward, the mines which are developing or the mines which are in the feasibility stage, the grades have fallen considerably. If you look at the right top hand corner of the map, you will find that the developing mines today are coming at a grade of 0.39, which means that for the same 1 ton of copper, they will now have to handle around 250 tons of ore, which is a 20% increase. This is one of the major drivers that will go in the consumable sector, where mill lining internals or the grinding media will be affected by this. Similar issue is coming with gold, where from 9 grams, they are going to go down to close to around 5 to 7 grams per ton of ore to be handled. The next driver for the growth is that both copper and gold in the next decade are supposed to grow at the CAGR of 3.7% and gold at 4.3%. Copper is basically on the electric vehicle changeover globally and focus on the renewable energy where transmission and other line will require a lot of amount of copper. Gold is the use of gold in the mobile industry and the growth of the mobile industry, usage in jewelry, as well as the use of gold as a safe haven in the times of economic crisis are the other drivers for the industrial growth as far as copper and gold is concerned. With this, what will happen is copper, the mill lining market, which is today 75% copper and gold, will move to close to around 78% as copper and gold. Next slide, please. Thank you. This will drive the global mill lining liner demand by close to around 6%, 5.8% CAGR for the next decade. Now, for us, apart from the industry growth and the growth in the industry because of the declining grade, the third vertical that is opening up for us is the Dynaprime, which is primarily focused on an area today, which is steel driven. Go to the next slide, please. Next slide, please. Yeah. If you look at this, I mean, as far as the industry is concerned, if you segment the industry in size from 2.4 to 9.5, the largest mill lining segment is the steel line segment in the hybrid for this sag mill for mills which are 9.5 meter and 12.5 meter in diameter. These are very large size mills. Driven by motors which are close to around 2,500 megawatt in this megawatt, 25 megawatt, sorry. Now this mills, Tega has the Dynaprime product, and this vertical which is opening us, the gain in the market share going forward will be the third driver for us apart from the industry growth and the declining ore growth. Over to you now.
Next slide. So if you can continue on to the next slide, please. So from here on, we're just going to touch upon some of the key investment highlights. So these are some of the highlights that we would be speaking through in the next few slides. So moving to the next, in terms of market share, we put ourselves at about 5% of the entire global mill lining market, which includes both steel linings and polymer linings. So the competitors that you see on the left are primarily steel lining manufacturers. And in terms of pure play polymer linings, we put ourselves as the second largest polymer-based mill lining company in the world. In terms of the hybrid lining space, which is the DynaPrime space that we have opened up for ourselves in the mills, which range between diameter of 9.5 to 12.5 meter range. Today, we are the only established player in the market with the credible reference base as of today. As explained earlier, the industry has barriers to entry, and some of the highlights, as I've spoken to you already, are featured in this slide. The downtime cost for a customer, if a mill goes down in terms of an unplanned shutdown, is north of about $174,000 an hour. So that's all the more reason why a customer would always pick a vendor to supply mill linings who has an established credible history with the product and the product design. So moving to the next slide, 75% of our revenues, as I said, is repeat in nature. It's year on year. And 25% of our business comes from conversions. So what is conversions today becomes spares for us tomorrow. Hence, for the customer, we are an OpEx spend. We are insulated from any CapEx cycles. And this also goes to prove the strength of our relationship that we have with all our customers across the world. Moving to the next slide. Product development and R&D has always been the backbone and the DNA of the company since inception. These are highlights of some of the 4 products that have come out of our stable amongst many others over our entire history. DynaPrime is something that I've already spoken about. Rapido is a screening solution for our customers. Today, traditionally, a customer spends a considerable amount of time replacing his screens panels. We have been able to reduce that significantly with the use of Rapido, wherein a customer can change out his screen panels in situ. Chute linings, we have modified the use of different materials in these chute lining offerings, which has helped customer achieve higher life. Trommels is a product that has come out of our stable and today is a global offering across the world. So we have over 8 global patents across the world. We have several trademarks, and our quest is to continue to innovate and provide design solutions to our customers in the form of either product development, improvements on our existing products, or completely new products. Moving to the next slide. As Yavor mentioned, DynaPrime is our product which has been a clear disruptor in the market. We've been able to address a large part of the market today, which was not available to us prior to the development of the DynaPrime, because that was primarily a steel lining market. Now, having brought a new product into the market, which is in direct competition to steel linings and has credibly replaced steel linings in a lot of offerings and has resulted in various deliveries to customers in terms of improved life, improved cost, lower downtime, has been much appreciated by our customers across the world. And we are in a strong journey to establish this product and take more market share in time to come. Moving to the next slide. This gives us a great view of the geographical presence of the company across the world globally. We have 3 manufacturing plants in India and 3 outside of India, 1 each in Chile, South Africa, and Australia. We have about 32 sales and marketing offices across the world. We ship to more than 70 countries across the world. We have a sales and service team of more than 155 people across the world. Almost 86.5% of our overall consolidated revenue comes from outside of India. And we ship to more than 500 customers across the world globally. Moving to the next slide. As I mentioned earlier, almost about 75% is repeat business, 25% is about conversion. These conversions come from either increase in market share, either in terms of replacing steel with our DynaPrime solution, or in terms of increasing our wallet share size of the customer. So these are various ways of how we define or classify conversions. And it's a significant portion of our efforts year on year to ensure that we continue to grow in this particular space. And as I mentioned, this is a direct outcome of how strong our relationships are with customers across the world. Moving to the next slide. Hosh is a joint venture company in the group. It's a joint venture with Hosh of UK. Hosh is its parent company is based in Germany, and the company is a 50-50 joint venture with Tega in India for the manufacture of belt cleaning solutions. We've been in this business for over 2 decades now, more than 2 decades, and is clearly a front runner in this particular product segment in the world, in the country. And we added Africa in 2006, as I mentioned. Lysurgeon is the acquisition in Australia. It's a distribution business for the Australian market. And of course, we have our presence in Chile, which was an acquisition also done in 2011. So the aim of these acquisitions was to not only expand our presence in those particular geographies, but also to be locally present, to have new products, new market segments available to us, so that we could penetrate the market stronger over a period of time. So moving to the next slide, Manoj, over to you.
Now, as we discussed, we do have very steady recurring revenues, which is demonstrated with the fact that 75% of our revenue comes from repeat business. It is reflective from our top line growth, which has become steady. Our operating revenue has grown at a rate of 12.74% CAGR between FY19 and FY21. And this growth has come from DynaPrime, which was disproportionately higher. So we have about 7% contribution in revenue of DynaPrime FY19, which has gone up to 21% in FY21. Material margin very steady in our business, and we have been able to make around 60% year on year. Hence, raw material cost per se does not impact us, because we have been able to pass through to the customers with the fact that they are critical to spares for the end user, though with a timeline of 3 to 4 months in between. The company enjoy very high operating leverages, and EBITDA has gone up from 16.4% in FY19 to 27.86% in FY21. Now, if I would have to normalize the EBITDA, operating EBITDA will be 24.2% against 19.8% in FY26. And if I take it normalized EBITDA in FY21, it will be 22% around, with the fact that few of the expenses like travel and others have not been incurred due to COVID last year. The business is having sales to PP ratio was 4.7 times. And last plant, green plant, which we have established is the Dahej, the cost of about 120 crores in FY13-14. Net working capital in the business is about 130 days due to the fact that we do import good quantity of input. And as because we supply almost 70 countries of the world, so we have a higher logistic timeline also. Hence, the net working capital cycle is about 130 days. Business is generating good amount of cash. And as of June, we have about 180 crores of gross debt and carrying about 250 crores of cash in the books. So net we are positive on our debt side. Next slide, please. Now, if you would like to compare ourselves with the listing peers, we can see AIA as a company with the fact that they also the critical spare supply to the same line of customers, though the products are different between us. And we find ourselves almost better or same in many of the KPIs between Tega and AIA. On a global front, we have few companies to compare with in terms of the product what we manufacture. But with the fact that all these 3 companies does have huge amount of capex product in their portfolio, hence not comparable apple to apple. Next slide, please. Go to Memo.
Yeah, so moving on, these are some of the key strategies that we're going to touch upon going forward. The desire is to continue to push for gain in market share. That's something that we have consistently done and demonstrated over a period of time. Leveraging our internal R&D and product development offering, as I said, is part of our DNA and is going to drive growth for us in time to come. We would be investing in expansion of our manufacturing capacities and capabilities in our different facilities across the world, and that is to cater to growth that we envisage over a period of time. We do see ourselves as being acquisitive in time to come. So inorganic growth is going to be an important piece of our overall strategy going forward. And of course, operational efficiency and margin expansion is one of the key pillars of our strategy also going forward. So moving to the next slide. Yeah, so I think with that, we'll probably come to an end to the presentation, and I hand it back to you, Lalit.
Thank you, sir. We hope the attendees have captured enough and more understanding about Tega Industries' business model, financials, and its execution capabilities. Before the floor is open for participants to ask their questions, I would like to reiterate to type your name and organization details in the Q&A chat box for the moderator to take note. Note, in the interest of time, we will be restricting to 15 to 20 questions only, and repetitive questions will be skipped. So coming to the first question, what came about the name Tega? Is the question which asks that.
Okay, so if I can answer that from history, I think when at the time the collaboration arrangement was agreed with Tega, one of the holding companies that the family had at that point was a company whose name started with the words techno. And the way the two partners decided between Skega and techno was to use the first two letters of techno and the last two letters of Skega, and that's how we put it together to name Tega. So that's how the name Tega came about.
Okay, so given that you've got 85+% of your revenues coming outside India, do you see this trend to continue, and are you hedged against foreign exchange volatility? Can the declining export benefits be attributed to such fluctuations?
Manoj, would you want to take that?
Yeah. We believe that this export content of 85% will continue and will grow from here. On the hedging side, we have policy intact in our company where we do hedge on a net basis. So we do have good amount of import also. So we do a net export hedging as per the policy, intent to do almost 95 to 100% as a part of policy through a plain vanilla forward. As far as the export benefit is concerned, yes, we do have export benefit in India, but in recent past, those benefits have been curtailed by the government, and may not be intently, we will be able to pass it to the customer immediately. But yes, in the near future, we'll be passing it out swiftly to the customers in year to come.
Thank you. Moving to the next question, which asks about the volatility in your EBITDA margins. Could you explain this? Also, how the raw material cost volatility is handled in terms of pass-throughs?
So on the EBITDA side, if you have just seen that slide, last year, FY21, we have had a EBITDA of 27.8% or 84% to be precise. And if I take out this non-operating income, consists of many things of one time and maybe recurring also, the EBITDA was 24.2%. Even I normalize it more in terms of that few expenses we not incurred because of COVID, mainly the traveling part. Our apple to apple EBITDA would be around 22.4% to be precise. If I compare with the 19, again, if I normalize it with the non-operating expenses in those years, it was 19.8%. So our EBITDA, operating EBITDA was 19.8% in FY20 versus 22.4% in FY21. And as because of high operating leverage, we believe that the company will be able to maintain the margin of 22% around in the near future also.
Thank you. Given that you've shown your top global competitors, there's a question which asks that, what gives you the edge and the moat? Is it the patents for the tech and the design or customization that you do for each mill separately?
Yeah. As far as our edge is there, on a global basis, we have a customer who is fully focused on the midlining segment. We are the only company fully focused. Other company have a basket of offering where they look at the customer and different products are there. That is number one. Number two, we customize every midlining. So we have, as you saw in the our spread globally, we have sales and service offices in every major mining countries, and the other countries nearby are being serviced by this team. So our ability to service the customer, design it, and install and post installation, do the servicing of web measurement, etc., give us a total edge on the global platform to customer anywhere in the world.
Okay, sir. Coming to the next question, any particular reason why there has been a focus on the direct sales model rather than moving on to appointing more dealers and distributors to expand your network?
So in our business, because it's a technical sell and has to do a lot with the explanation of the value that we demonstrate in forms of the engineering and design, the customers expect that the manufacturer like ourselves, and that's true of a peer group also, that we are expected to interact with the customer directly to be able to position our product in terms of show them and demonstrate our designing capability and our solution to them. So typically in our business, we have not found it appropriate to have a dealer or an agent represent us in this particular transaction, because they would not have the wherewithal to be able to demonstrate clearly to the customer what our position is. So typically in our business, it's always a direct sell to customers. But of course, we do have a distribution business also, but that's for some of the other products which are not a significant contribution to our overall top line. But the intention is to continue to grow the distribution business for the other product lines which are other than the mill lining segment, which is purely direct sale.
Thank you. So moving to the next question, which asks that what is the time period involved when it comes to development and commercialization or an improvement of your product? Could you take us through the process briefly?
Yeah, as far as the Dynaprime was concerned, it took us close to around 6 years to come with the product. We started the first foray into this area by taking the customer voice on what the problems are there, and the total development cycle from the start of the designing process to the first commercial trial that we did it took us around 6 years. Having said that, there are different products. Some product, the life cycle, development cycle is close to 2 to 3 years, but it can be varying between 2 to 3 years to 6 years that it took with the Dynaprime.
Thank you. So moving to the next question, which is being asked by multiple people, could you reiterate on your global market share as you've showed it in your presentation?
So our global market share for just the mill lining segment is like I mentioned, is on the presentation, which is 5%. That includes both for the steel lining and polymer lining segment. But because the industry is so dispersed and wide, and with lack of credible data in terms of research reports on the polymer mill lining side, just by sheer volume and revenue from what information we have, we put ourselves as the second largest in the world for the polymer mill lining segment, and we don't really have a definite source of market share for that particular segment.
Thank you, sir. Moving to the next question, which asks that since everything is customized, it is assumed that the inventory levels should be high given the geographic diverse customers that you have. What is the trend there?
No, we manufacture product after receiving orders for that segment. We are not manufacturing shipping, but the inventory, I think Manoj will take care. Inventory is in the terms of raw material, etc., required for us to manufacture the product. But we don't manufacture and keep product as an off-the-shelf product. These are all against specific orders. Manoj,
just to add that point on inventory, actually we can break up the inventory in two parts. One is strategic buying, one is the PO based buying. So on the strategic buying, we have some common product like specialized steel, rubber. This we buy on a strategic basis because it's a regular requirement for us. And good amount of content is import also, so to plan in advance. And the second part is more of a PO base, where we go based on the order basis only. So most or major the material is basis the purchase order which we get from the respective customers and not other ones.
Thank you, sir. Next question to ask is, do you have any kind of seasonality or cyclicality in your business?
No, we are in the operating plants. So most of the operating plants, until unless plant closes down or reduces the production, then only is the question of cyclicality. We are not affected by the commodity cycle, or both on the pricing or the capex side only. So the capex side, the growth part is there, but as far as the operating this thing, we are on that. Having said that, most of the major miners operate on the calendar cycle. So most of their shutdowns are in the second half of the calendar year, which affects our revenue cycle. So our revenue cycle is aligned with that. So it is not there, but in a year, you will not find any seasonality as far as year to year.
Thank you, sir. Moving to the next question, which is on your EBITDA margins. Even if you consider normalized margins, how sustainable is it, in terms of sustenance?
So as I mentioned that historically we were at 20% plus EBITDA. And as because the high operating margin, the higher volume give us a better EBITDA going forward, because cost will not go, disproportionately or equal to the top line. So as mentioned in my earlier answer, we still of the view that the EBITDA, what we're talking about of 22.4% is sustainable going forward with upward bias.
Moving to the next question, sir. Why is your PAT margins fallen this year?
When you say this year, talking about Q1?
Yes, sir.
So as Mr. Yawar said that in our business, quarter to quarter comparison may not be correct, with the fact that this it depends on the calendar cycle of the mining company order cycle. So they go with the Jan to December cycle, and they tend to give the lower order in the first half of the company calendar year, which tends to be a lower revenue in our first half of the financial year. And then they tend to release the higher order from their budget in second half of the calendar year, which converts revenue in our H2 of this year. So generally the mathematics that 40% to 42% revenue in H1 and about 58 to 60% H2. So therefore, the EBITDA percentage, both in terms of percentage and absolute, will be much higher in H2 than H1. So to make the yearly, full year number of EBITDA compare on year-to-year basis and then Q2, there's a sequentially quarter-to-quarter basis.
Thank you, sir. Moving to the next question, which asks, which are your major revenue contributing countries?
So last year we have South America was the number one, then Africa, number two.
Okay. Moving to the next question, which asks, revenue contribution from South America has come off in Q1, and the customer base has come down from 513 to 212 in Q1. Can you throw some light on this?
Yeah. So on the first part of the question, as I said that we have to see entire year basis or Q1 basis. So when we say 17% against 24% last year, it depends on the shutdown cycle of the respective customer site. So they tend to get the material close to the shutdown site. So therefore, as Mr. Yawar said, the shutdown site is more on the later part of the year, and every geography may not have the same kind of mix and match. So therefore, the 17% Q1 may not be comparable with the 24% in full year last year. And on the second, can you just repeat the second part?
So the second part
Yeah.
asks, the customer base number has come down from 513 to 212 in Q1. Could you throw some light on that?
Yeah, so 513 is the number for the entire year. So it is not that entire 513 will come in the quarter itself. So the 212 number is a installation site where installed the liners for that quarter, and 513 is the installation site for the entire year. So as the cycle is different for all the product from 6 months to 18 months, 24 months. So it's a cyclic things which will come up in the later part of the year going forward.
Thank you, sir. Moving to the next question. The new products, as you spoke in your presentation and showcased it, what does it contribute to your revenue? How has the growth been for them?
So new product, as I said that we started DynaPrime in FY 18-19. So that has started with the 7% contribution in the total revenue of the company, operating revenue of the company, which has gone up to 21% in FY 21. So obviously that has given a disproportionate growth to the company, and going forward, we are of the view that DynaPrime will be continue to grow disproportionately of the total revenue from operation.
So the next question asks for a segmental revenue breakup between mill liners, hydrocyclone screens, and conveyor belt products.
So we have about 70 to 75% on the mill liner due to DynaPrime. And non-mill liner is about 25%. So when you say non-mill liner, the screen will be about 12 to 13%, and rest consists of where hydrocyclone is a balance.
Thank you, sir. Moving to your the next question, which is being asked, is that given that we are gaining market share, is it that our products are cheaper than global giants?
No, I mean, it's not a question of products are cheaper and all. If you look at the value proposition which we are giving, we are looking at the benefit we are through the product. We are not doing a one-to-one replacement. We are disrupting this thing and giving value addition to the customer either through productivity gain or the shutdown time reduction or in the installation time reduction. And in all these three cases, you know that the shutdown time for cost for the customer is close to around $200,000 an hour. So we do this passing through of the benefits and pricing of it. Depending upon the segment we are operating in, somewhere we are price leaders, somewhere we follow, but the margin difference between major players are not very high. It is in a single digit figures depending upon which market you are operating in and where we are trying to get market share. And once we establish ourselves, the value addition we do continuously to increase the margins once we have retained the customer.
Thank you, sir. Moving to the next question, which asks, does a new customer addition come with lower margins as you replace the incumbents? Also, once you break into larger miners, do all sites open up easily or each is worked upon independently?
No, as far as the mining industry is concerned, they go work with mine to mine, So each of the mines will be taking the decision on their own, and we operate mine to mine. So it will not be a global opening this thing, but when you have used major miners have used this product and have started using this, it starts opening the door easier. Okay. Second is depending upon the budget of the customer. When we are working tightly with the customer and changing over to a new customer, more or less we go with their budget, and the pricing would be if we are replacing steel liners as we are doing with the DynaPrime, the pricing would be exactly more or less same to that steel liner pricing, because that is what the customer is paying, and the changeover for the customer is due to the benefit that he is getting. So at the time, what we get is the price of the steel liner, this thing, not below the price of the steel liner. So it is not that when we are changing from major global this thing, it is at a lower price.
Thank you, sir. Moving to the next question, you have certain direct tax exemptions on account of your manufacturing facility in Dahej. For how long can you avail this, and what is the percentage benefit, that you have on your total income?
Yes, so we were having the benefits under SCJ until FY20. Post 21, we have given up and we have gone to single rate of tax, because we find that is equal or better than the normal rate what we are getting net of benefit to the SEZ. So we have moved to single rate from FY20.
Thank you, sir. Moving to the next question, which asks, what is your credit policy with your customers?
So we have mix of policy. In some country, we have LC backed or advance payment. In some countries, we have open credit where we have good relationship with the customer, which is more than 7, 8, 10 years, where we don't have any past history of any payment issue. And somewhere we have also consumption bills. So it's a mix of 2, 3 levers.
Thank you. Moving to the next question, given that we've, in the past focused on our growth through inorganic means, is that focus going to continue?
Yes, as I mentioned, as part of the strategy, we do see ourselves continuing to pursue inorganic opportunities, but they are very difficult to time, as and when those opportunities present itself, they would be critically evaluated and we would consider it if and only if it makes complete sense to acquire those businesses and have incremental growth coming through them.
Thank you. Moving to the next question, which asks, what has been our capacity utilization over the last 3 fiscals, and what do you see as capacity levels to be sustainable in nature?
So capacity wise, we have about 25,000 ton of capacity, and as of today, we are using about 55% of capacity. And basis our business and lumpiness, as I said, we can go up to 75% capacity utilization.
Okay, so there's a question which asks, how different are our products if compared to Tega Engineering, who also caters to the mining industry?
Tega, our product is different. We are in a different segment. Tega major business is in the belt splicing, not over here also and globally. So they are more in the service sector while we are in the product sector, catering to the same segment of the market.
Thank you, sir. Another question with respect to a peer is, how are we different from AI engineering?
Again, AI engineering is supplying to the same customers base, but they are supplying the grinding media which is used inside the mill. We are supplying the liners which transmits the power from the motor to the grinding media. So while when we look at the grinding media business, it's more of a commodity business where products are standard and supplied as a standard this thing. Where in our case, it is a complete designed and suit to the site conditions.
And just to add to Mr. Yavar, we compare only with the fact that they are also critical spares and we are also critical spares. Otherwise, our product are very different. Only point of comparing is critical spares for the end user.
Thank you, sir. Moving to the next question, which states that, given that, we have a high barrier to entry in the space that we are in, where do we see the additional revenues for the company coming from?
Now, while the barrier to entry is high, there is 2 things which is happening over here. When we are looking at breakthrough products or disrupting products, the barrier to entry starts getting lowered because of the value addition that the customers are getting. Today, with the Dynaprime, when we have got the market share and gaining a market share over there, it is focused on converting the customer to saying that you have a product over here, our engineering expertise and our also on the background of the last 20 years of providing you value-added product. This is a product which will give you this. And as Mehul had said in the beginning also, our engineering solution is backed by huge amount of technical simulation where we show both the existing and the proposed design to the customer. They go through a trial process and then do it. So for us, the growth will continue to come from this sector where we will be looking at changing and disrupting the steel business with our Dynaprime product.
Thank you, sir. Could you give us an indication of what your order book is as on June 30th, 2021?
It is around
It is around 300
crores. 316 crores.
316 crores.
Okay, sir. There's a question which asks that could you please outline the benefit for the customers shifting to Dynaprime at the same price as steel mill lining, sorry.
Can you repeat? I missed out a bit over there.
Could you please outline the benefit for customers shifting to Dynaprime at the same price as steel mill lining?
See, what happens is there are two things. When steel liner is being operating, and if they are at the second half of the life of the liner, which is close to 4 to 6 months, if they are having a crack in the lining, they have to take a shutdown, and a couple of hours of shutdown over there cost them close to around $200,000 an hour. Second is our Dynaprime, the installation time reduction is we give a substantial reduction in the installation time. With this reduction, again, if the customers are gaining through the reduction in the cost of this thing, as well as, again, that downtime at so many dollars per hour is getting as a benefit. So while they are buying the liner one-to-one, these benefits start making it much more lucrative than any other aspect of the pricing.
Thank you, sir. Moving to the next question. We have a rate contract for supplies to our customers, or is it different for every order?
There are certain level of customers who we have rate contracts. These are not rate contracts, which we have a contract running for 2 to 3 years. And here, with the escalation clause with pass through of the cost, we have this thing. But large amount of customers, we have continuous order book every year. And since we have very large amount of stickiness of customer in these kind of this thing, our repeat orders are close to around 90-95%.
Thank you, sir. A question which asks, are you selling the products to coal mines too?
Old mine.
Coal mines.
Sir. No, not coal. Again, as you see, what I told you, if you coal does not supply use mill lining globally very high, because coal is a naturally occurring mineral where the 90% except for in India where it is a little lower, but coal is just crushed and screened, and so screening and other product will be there, but not mill lining.
Thank you, sir. A request to repeat the order book figure as on 30th June, since the attendees couldn't hear it clearly earlier.
316 crores.
Yeah, 316 crores.
Thank you, sir. Moving to the next question. Could you give us a little more clarity on the CCCP shares issued in FY21?
No, so CCPS, no shares has been issued per se. It is a conversion of the CCPP in equity in FY21. So as per the terms of the SHA with the P investor, there was a event which has to be occurred. So one of the event was going to public. So as because that event is occurred, so that CCPP has been converted into equity shares.
Thank you, sir. Given that we've attended most of the questions, and if anything else has not been answered, we will definitely reach out to the person who's asked the question. Thank you, everyone, for showing interest in knowing more about the company and its leadership and future potential. I would now like to call upon Ankur, to do the closing speech before we end today's webinar.
Thanks, Lalit. On behalf of Axis Capital Limited, let me first thank each and every one of you for joining this IPO meet. To what has been highlighted during the course of the webinar, this is a very differentiated business model with very strong financial performance. But one thing which clearly stands out about this company is the way the promoters have built out this business and the passion which they have, backed up by a very strong, flawless execution team. We would like each and every one of your support in making this IPO a grand success. Just as a reminder, this IPO opens on 1st of December and closes on 3rd of December. And we look forward to having your support for this. Thank you and have a great day.
Thank you, Mr. Agarwal, esteemed audience. We've now come to the end of the webinar. We look forward to your participation and support on making this initial public offering a great success. Wishing you all a great day and keep safe.